All right, welcome back to Ryan Miller Trading Economics. This macro breakdown will be on the US dollar index at the DXY. All right, so let's get right into it. So as we know, over the last year or so, dollar's been moving higher. Okay, now the question becomes, is the dollar going to continue to move higher? Is this move in line with the fundamentals? Do the fundamentals support dollar's continued move higher? Okay, that's where we're going to find out. So let's start to break that down a little bit. Now, let's keep this simple. The US dollar is the underlying collateral to the entire global monetary system. When dollars are flowing, things are good. When they're not flowing, things are not so good. And so when dollar's up, global growth is down. Dollar's down, global growth is up. It's really that simple. And when there's any type of crisis, recession, whatever it may be, you see the dollar move higher. And it's very consistent. And you can verify this simply by looking at a chart. So if we looked at the dollar index over the past 25 years, go back to 97, 98, Asian currency crisis, dollar moves higher. Dot-com recession, dollar moves higher. Global financial crisis, dollar moves higher. Euro sovereign debt crisis, 2010, dollar moved higher. 2014, devaluation of the Chinese yuan, dollar moved higher. 2018, global manufacturing recession, dollar moved higher. COVID, dollar spiked higher. Okay. And if you look at it from a growth perspective, during the last 13 years, when there's been growth rate upturns, reflationary periods, dollar move lower. Growth rate upturn, dollar move lower. Growth rate upturn, dollar move lower. Dollar move lower. Since about Q2 2021, we've been in a growth rate downturn, and the dollar has moved higher. It's very consistent. Now, as we know from the last video, that when we broke down the equity indices, we did a full macro breakdown of the economy, where it is and where it is likely headed based on a basket of leading economic indicators. And those leading economic indicators tell us that growth is going to continue to slow down in the coming months, over the coming, say, next couple of quarters, next 6 months or so. So if growth is going to continue to slow down, that means there is room for the dollar to move higher. Okay, so if you're not on board with that, go check out the last video on the equity indices, and I go through where growth is and why it's going to continue to move lower based on leading indicators. Okay, so there's room for the dollar to move higher as growth continues to slow. Now, some of you may say, oh, but the Fed's going to pivot, right? That's going to push the dollar lower. Now, I don't think the Fed is pivoting. I think it's going to happen, but I don't think that's a short-term thing. I don't think that's coming until maybe end of year 2023, until recession is already upon us. Now, even let's make the argument that the Fed is going to pivot. Now, that doesn't mean they're done cutting rates and they're going to start, they're done hiking rates, they're going to start cutting rates right away. No. Once they stop hiking rates, there's going to be a period of time where they pause, where they don't do anything, where interest rates stay at these elevated levels. Okay, and you can already make the argument that the Fed has already over tightened. And we can look at one chart that presents a lot of information that the Fed is already over tightened. Now, this chart is from Eric's website, which I've talked about. You can find this under his blog. It's free. Record debt plus record rate spike. It's one of my favorite charts, and it shows interest rates, private borrowing rates, mortgage rates, corporate rates, and short-term treasury rates. So as the line is inverted. So line moving down means interest rates are going up. Line moving up means interest rates are going down. So if we went back to before the tech bubble, 2000, we had a spike of interest rates about 200 basis points, while overall debt to GDP was 272%. Enter recession. Fast forward to the GFC, we had an interest rate spike of only 150 basis points. Debt to GDP was higher, 334%. Recession. More recently, we had a interest rate spike of only 129 basis points, but debt to GDP was 343%. Right? So as debt has gotten higher, and higher as a percentage of GDP, it has taken less and less of an interest rate spike to send us into recession. Now, here we are with the fastest rise in private borrowing costs since the early 1980s, and we have debt to GDP 370%. So the fastest rise in private borrowing costs since the early 1980s, and we are about 200% more over indebted now than we were in the early 1980s. Right? So if you were just to draw a conclusion based on this chart, where do you think it's headed? Now, we don't want to look at just one chart or one indicator. That's why we look at a basket. This chart gives us a lot of information when you combine it with all the leading indicators we looked at in the last video. This tells us that even if the Fed were to stop hiking rates, they've already over tightened. That private borrowing costs have already gone too high, right? That growth is going to continue to slow because interest rates are a leading indicator, right? They have an 8 to 12 month lead time. So a lot of their impact hasn't been felt throughout the entire economy yet. So there's more downside in the economy just based on this alone. Okay. So when we start putting all these things together, the fact that growth is going to continue to slow, and we also have potential for crisis out there, right? Europe's in a recession right now. They have inflation that continues to move higher. ECB's been forced to start raising rates. Going to probably have to continue to do that because their prices are going, inflation's going higher, and they have countries like Italy that are so over indebted. Higher interest rates are going to threaten to put them in default. Right, that's a potential crisis. China's real estate market is on the verge of exploding. The real estate bubble is on the verge of exploding. That's a potential crisis. So we have the fundamentals and potential crises out there globally that could send the dollar higher, right? So we should expect the dollar over the next, say, 6 months or so, as growth continues to slow, and there's a lot of these vulnerabilities in the global economy, that the dollar should continue to move higher. And that's exactly what it's been doing, right? So technically, if we were to take a look at this, as you can see on the weekly, it's been in an uptrend. Right? We broke a pivot high a while ago back in 2021, and it's been moving high, creating higher highs, higher lows along the way. And we had this big pullback, and people thought, oh, hey, this is the top. Right? Maybe it is. Maybe we don't get above here again. Right? But the fundamentals say over the next 6 months, there's a good chance we are going to get above here, going to create a new high. But we had this big pullback. Okay. From a weekly standpoint, it never broke any structures. It stayed within this pivot high. This pivot low. Right. Nothing to be concerned about if you're long the dollar. So how did we know when this pullback was going to end? Well, if we looked on the daily, as it started to pull back, hang on, let's go back to the weekly first. We pulled back right into this area of demand. Right? If you're not familiar with how I'm drawing supply and demand levels, check out my framework video on the technicals. We pulled back into this weekly supply and demand, and we pushed out of here. And what did we do? We broke this pivot high in the daily. Right? So we broke a pivot high to the upside, back in line with the fundamentals. Okay. So now, as we know, so we have a broken pivot high, we have this low, now we have a high, right? So from a daily perspective, what we're looking for is then a pullback to create a higher low, and then a move higher to create a higher high. So we have an established uptrend from a daily perspective. So this move here, once we broke this pivot, this is a strong signal that, hey, if I'm already long the dollar, I have nothing to worry about right now. We're broke a pivot back in line with fundamentals, all as well. This could give you confidence to get in the trade if you're not already in the trade. If you want to be precise and look to get into this trade, well, let's wait for a pullback. Hopefully we get one. Right? Hopefully we get a pullback into this structure, and we're going to look to get in as the higher low is forming. Right? So some areas where that could potentially happen. We have some demand there. We have some demand here. Obviously, they can form anywhere else. But these are some areas. If we get a pullback, I'd be looking for price to form a higher low, anticipating that higher low forming and looking to get in. So as price pulls back to one of these areas of demand, depends what type of trader you are. Maybe you look for some exhaustion, an engulfing candle. You wait for some structures to be broken, or you can drop down to like a 4 hour, wait for some structure, a couple minor structures to be broken on the 4 hour to tell you, okay, higher low is probably in now. Wait for some type of reversal pattern, however you like to do it. But that's what I'd be looking for if I'm looking to trade this. We have the low, we have the high. We just broke this pivot high here. We're in line with the fundamentals, with the conditions of potential crisis out there, which all say dollar is going to likely move higher over the next, say, few months, 6 months. I'm just looking for a pullback, for a lower high to form, to look to get in to this trade. Now, where obviously the first target would be this high here that was most recently formed. Now, this is a pretty weak high, never broke any structures. It's within this pivot low. There's really nothing to worry about. So this high theoretically shouldn't hold, right? It might, but it shouldn't hold. We should be looking to, because we have the fundamentals in our favor. Technically, this is a weak high. We should be looking to trade beyond this. So if we just went up to a monthly so we can fit it all on the screen here, we have some room to run. So price stalled at this structure here, at this area of supply, right? Pulled back a bit there. Now we're moving higher. So back in the tech bubble, you had this big M form, right? Right there, this big M reversal pattern. Oops, hang on. This big double top, right? Which hasn't, doesn't seem to have been tested yet. So we have structure starting right about here. That's when sellers are going to kick in. We also have, if you look closely, have this area of supply here. So draw that out. All right, right about there. We have this structure, right? This major structure off this big reversal pattern. We also have an area of supply there. So I should expect sellers to start stepping in there. So that's around the 111 to 112 area. So that would be our next target, right? Look for that pullback on the daily. Hopefully you get it if you're looking to trade it. And then we're going to look to target this 111 to 112 area. Obviously, it could go higher, right? All the way up to the top of this pivot. We're talking 120. Dollar's getting up to 120. There's some big problems globally. Some big problems. God forbid we break above here and start targeting levels up in this area. Well, hopefully economically it doesn't come down to that, because that means things are falling apart. All right, but technically we've had this move higher in line with the growth slowdown. We expect growth to continue to slow down. Okay, there's potential for crisis out there. And during crisis, during growth slowdowns, the dollar moves higher. So this move technically is back in line. We had the pullback, and now this move is back in line with the fundamentals. So again, pullback, look for the higher low. We're going to look to target this 111, 112 area. That's it. It's really that simple, right? You can complicate this many different ways. Just keep it as simple as possible. That's what we're going to try to do here. Okay. If you have any questions, as always, let me know. Like, share, subscribe, and I will catch you in the next one.